A year ago, when many investors were selling real estate stocks, Paul Leupp, founder of Grubb Ellis, he was buying. The end result, his Realty Income Fund returned 72% last year, outpacing the S&P 500 and its peers. And Jay is joining us now from our San Francisco newsroom to talk about his strategy. Jay, thanks a lot for coming in to our San Francisco bureau. We appreciate it.
Good to be here this morning.
So, talk to us about the real estate opportunities that you're seeing right now, because we have had a little bit of renewed interest in the industry, especially evidenced by what's going on with the battle for general growth.
Sure, and what we're seeing now is also investors really hungering for yield. We're in the early stages of a 3 to 5 year recovery in commercial real estate, and investors now are looking both for yield and also value in the commercial real estate space in both the REIT common stocks and the REIT preferreds. A year ago, it was almost impossible for even REITs to borrow money, and the stocks were sold off in what looks now to be basically a panic in the space. We were fortunate that we invested heavily in REIT preferreds, which have a level of safety above the common, and also in some of the value common names. The REIT shares in general, in front of a recovery, tend to lead in terms of price performance about 8 to 10 quarters. And so you've seen a real bounce, not only in our fund, but in REITs in general. And we think that is foretelling an eventual recovery in commercial real estate values.
But when does that momentum start to slow in terms of the stock price recovery?
Well, the stocks are up about 20% in the last 8 weeks, so we're not expecting a lot of appreciation in the near term. In fact, it could be very possible that the sector corrects a little bit as we get into first quarter earnings. We have some positive surprises, some negative surprises, and investors recalibrate. So the stocks could take a break after having a big move in the last 8 weeks, and if that should be the case, we'll be hunting for more value.
Speaking of hunting for more value, tell us about your value bias.
Well, right now, we are investing primarily in real estate areas that we think are going to benefit from the early stages of an economic recovery. That is, benefit from renewed job growth, which we expect to kick in the back half of the year. We like apartments. One of the stocks that we like right now is a preferred issue of Associated Estates. The common ticker is AEC, and we like AEC Preferred Series B. This is a preferred share that has about a 9% yield. This is a company that has 11,000 apartment units, primarily in the Midwest of the United States. This portfolio is about 94 to 95% occupied. Yeah. And we think the next step for this portfolio is actual rent growth beginning in the back half of this year. So in our view, investors are being paid to wait for a very healthy 9% yield.
Jay, could I ask you very quickly, because you did mention job growth, that ADP number today, did that give you cause for concern, or are you waiting for Friday's number?
Yeah, we're waiting for Friday's number, and again, we're not overly bullish at this point. We think this is going to be a slow, sluggish recovery, but we think we're very close to seeing unemployment peaking in the 10% range, and that we're going to have really a slow crawl, maybe 100 to 150 basis points pickup in employment. That is, the unemployment rate dipping to 9 to 8.5% over the next 12 to 18 months. So it's going to be a slow crawl back, but we think that the recovery is going to begin sometime toward the middle of this year.
So for that reason, you think, to get back to Associated Estates for a minute, that's what is going to allow them to raise rents? Because up until now, renters have been pretty resistant to any attempts to do so.
That's right. It's a very good point, is that in general, renters have been doubling and tripling up, or in some cases for young people moving home. Apartment landlords, at least the real estate investment trusts, have been focused on essentially maintaining occupancy. And so the strategy is to essentially give up some rent growth and even give up some rent concessions. Rents in general in apartments are down about 10% over the last 12 months in return for maintaining high occupancy. And a 94 to 95, 96% occupancy rate going into a jobs recovery is really a good place to be. And we think that rent growth is probably flat for the apartment companies through the back half of this year, but that 2011 could be a year of 3, 4, maybe even 5% rent growth.
I just very quickly want to ask you about another one of your picks, Sun Communities, manufactured housing. With all the supply that's already on the market of regular housing, how is manufactured going to grow?
Well, we think this is a low entry point for the home buyer as the home buyer returns, as job growth continues. And Sun Communities, SUI, actually owns the land underneath the manufactured home. So typically the way this works is a home buyer buys the actual manufactured home and then looks for a community that is owned by a REIT like Sun to actually anchor their property, and then they rent this land. Essentially, Sun is a portfolio of communities that are about 37,000 rental pads across the country. This is a stock with a 10% yield, trades at 9 times earnings, and we think, again, is positioned for rent growth going forward.
Okay, we're going to have to leave it there, unfortunately, but thank you again for joining us. Jay Leupp, founder of Grubb Ellis.